So a question we receive quite often is, can I fund a whole life insurance policy with a qualified account? An example of a qualified account would be your 401k or an IRA. And the specific question we often receive is really this: can I transfer money that I have in a 401k to a cash value life insurance policy, and can that transfer be tax-free? And then be able to access the money in the whole life insurance policy tax-free? Meaning, can I avoid the taxes? The answer is no. Unfortunately, that is not possible. So we're going to talk about that today, and we'll talk about what is and is not possible, and then we'll go over a few options that we often like to discuss with individuals as far as what can be done when it comes to taking money that you might have in a 401k, an IRA, a qualified account, and moving it into a whole life insurance policy. So the topic is funding a policy with a 401k or an IRA, which is a qualified account. So a qualified account is an account that you have funded with pre-tax dollars. So for example, if you have a 401k at work and you contribute $10,000 per year to that 401k, that $10,000 contribution is tax deductible to you. To illustrate, if you earn $100,000 annually and you contribute $10,000 from your income to that 401k, what happens with respect to your income and taxes specifically? Well, your income before the 401k contribution was $100,000. You made the $10,000 401k contribution. You were able to deduct that contribution, which lowered your taxable income from $100,000 to $90,000. So you contributing money to the qualified account allowed you to deduct some of your income. So you saved on taxes now. That is one advantage to qualified accounts. Now, when it comes to taking money from a qualified account and trying to move it directly into a whole life insurance policy, here's the issue. A whole life insurance policy is considered a non-qualified account, or I wouldn't use the word account. A non-qualified asset is what a whole life insurance policy is, specifically when discussing the cash value. A way to explain a non-qualified asset is when I fund the policy, I'm funding it with after-tax dollars. So unlike a 401k, which is a qualified asset, when I fund that or when I contribute toward it, what happens? I fund it with pre-tax dollars. I'm able to deduct the entire contribution amount for that 401k. With a whole life insurance policy, I cannot deduct the premium and PUA payment. So when I'm funding it with after-tax dollars. That means money I've already paid taxes on. A nice account to relate this to could be a Roth account or a Roth IRA. A lot of times people think of traditional IRAs and then Roth IRAs. The difference is with an IRA, I may be able to deduct the contributions, whereas with a Roth IRA or a Roth 401k, I do not deduct the contributions. It's funded with after-tax dollars, and then with a Roth, it grows tax-free. I hope that made sense. But a whole life insurance policy would be more similar to that of a Roth account. And again, none of this is tax or legal advice, just discussing different assets and questions that people often have. So with that said, the question that comes up is this: can I transfer money from my 401k or the entire 401k to a whole life insurance policy? Because with a 401k, when you've contributed toward it, how did you do that? It was all with pre-tax dollars, meaning you have not paid any tax on the money that has gone into the 401k. So when you eventually want to take money from that 401k, how much tax do you have to pay? Or what do you have to pay tax on? Just the gains or on the entire asset? It's on the entire asset with a qualified account. So hence the question, what people are interested in is potentially taking money they haven't paid any tax on and transferring it to an asset that I can access the cash value completely tax-free. Unfortunately, that is not possible at all. We cannot do that. So a 401k cannot be transferred into a whole life insurance policy, or I should say, it cannot directly be transferred into a whole life insurance policy. Here's the key on this. Money from the qualified account must be withdrawn first. And really what that means is I need to take money from the qualified account, call it the 401k, and that's booked as me taking a withdrawal. So if I had, let's call it $100,000 in a 401k, I took that $100,000 out, I can then put it in the policy or do whatever I want with it. But when I take that $100,000 from the 401k, what happens to my income that year? I've got $100,000 of income that I now have to account for. And if I'm under the age of 59 and a half, or I'm in the neighborhood where I have to pay a 10% penalty tax, that could make things a bit worse. So when I say the money must be withdrawn first, when we withdraw money from the qualified account, I do have to be aware of the taxation that will occur. And that's something we do like to look at or encourage you to discuss with a financial advisor or your CPA, because if we're going to look to fund a policy from a qualified account, if that's where I've got a lot of money, we really need to figure out before executing the strategy how much tax is going to be due every time I take a withdrawal from that qualified account. And then how do you intend to pay the tax? Very, very important to have awareness on that first. So we've actually got some case studies that demonstrate individuals taking money from qualified accounts and moving it into a whole life insurance policy. There's two main reasons. One is the immediate benefit, meaning the cash value. They're interested in that asset, whole life insurance being a fixed asset, safe, liquid, tax-free, the stuff we always talk about. And then two, from a legacy planning standpoint, meaning if I want to pass money on to the next generation, and I'm going to do so through a qualified account, tax-deferred money, or through a life insurance policy, in almost every case, you'll see life insurance is very, very efficient there because the death benefit is passed income tax-free. And there's nice ways you can leverage both asset classes when spending your money during retirement and then also passing money on to the next generation. I would check out any of our retirement videos that go through how people often leverage accounts. I do not encourage one just cash everything out and move it to one asset class. We see that sometimes, and I'm not a big fan of that. So some options here. If I've got $500,000 in a 401k and I want to move that into a life insurance policy, option A, you can cash out the 401k. So if you have $500,000 in a 401k and you cash it out, what's going to happen to your taxable income that year? Yeah, it's going to be $500,000. Actually, if you have any other sources of income that's taxable, that $500K would be added to it. So you're going to pay a lot of tax that particular year if you cash it out. Option B, you could look at this, a 5-year cash out. What that means is if I've got $500,000, let's assume it's earning 0%, you would take $100,000 per year, and then you can take that $100,000 per year and move it into the life insurance policy. Well, it likely wouldn't be the full $100,000. The reason why is every year you pull out $100K, what happens to it? Subject to income tax. And based on your financials, it might not make sense to move the full amount over. That's where the planning comes into play. But a 5-year cash out just means we're going to gradually do it. And a lot of times people are more attracted to this type of strategy because it lowers my taxable burden on an annual basis. I've only got to factor in $100,000 of additional income, or at least what I'm going to have to pay taxes on every year, instead of a big hit of $500,000, which will probably put me in the highest tax bracket. Now, another option here, option C, you could roll it over or transfer it to an annuity, and then have the annuity fund the life insurance policy. So with this option, when I take that $500,000 in the qualified account and I move it over to an annuity, if it's a rollover, that can be a tax-free transfer. So the $500,000 from the 401k moved over to the annuity does not trigger any tax. However, the annuity then, as it disperses the money into the policy, that does trigger tax. So you can set up an annuity with most life insurance companies that you take out a life insurance policy with. So for example, if I went with life insurance company ABC, that's who I want a whole life insurance policy with, and I decide to purchase an annuity with that exact same company, what you can do is provide instructions to the insurance company to have the annuity fund the policy directly. This way the funds, the disbursements from the annuity, never go into your account. Pretty interesting. However, let's say it's $100K For 5 years going from the annuity to the life insurance policy, that $100K, even though it went straight into the policy, you still pay income tax on as if you received it directly. So it's important just to have awareness of that, because some might look at that and say, wait a minute, why do I have an additional $100,000 of taxable income? I didn't get that money in my bank account. Yes, you're correct. It went into the policy. And then some might decide to take a loan against the policy or something like that in order to cover the tax. That sometimes makes sense. It does not always make sense. Again, I would always consult with a CPA or tax attorney in these particular cases. So I hope this was helpful. Let us know if you have any questions at all. Feel free to leave a comment below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.